Good morning. Welcome to Real Estate Radio Denver, the most informative hour of radio over the weekend, and we're here every Saturday on News Talk 710 KNUS from 9 to 10 a.m. Thank you so much for joining me. I am your host, Tom Souther, and Real Estate Radio Denver is dedicated to building Denver's housing and credit markets. We are here to give you that timely truth that we feel you're just not hearing on the national news outlets and sometimes not even on the local guys. We're here to help rebuild that Denver marketplace, and we do that one home at a time, and we do it by giving you some great advice, a little bit of education, and connecting you with professionals that can help you, whether that's buying or selling a home or financial tip, you name it. We've got people in the wings that can give you a little good advice. So within every market, there's some solutions, and there's just tremendous opportunities, and that's what we're going to talk about today. We've got a topic that we haven't covered before, and we want to get on that in just a minute. I want to also remind you, please give the show a call. You can reach us off air. I love to help you to connect with the right person. You can do that by calling the off-air number, 720-515-1818. Again, 720-515-1818. And I will, or one of my staff will put you together with the right person. And last week we had a great show. We talked about some investment property. We talked about a lot of what's going on in Denver specifically. And this week we're going to broaden it up a little bit. There has been a huge amount of activity and growth in the marketplace, and it's kind of revitalized a piece of the marketplace and a tool in the marketplace that we just haven't heard a lot of about in the last few years. So we're going to talk about 1031 exchanges, and I've got some great experts. If you don't know what that is, it's all about how do you take the equity or capital gains out of one property and transfer it over so that you're not taxed on that. And it's going to be a great show, and I've got some great experts. I want to introduce them now. I have Danita Vigil and Tracey Wilson, both with IPX 1031 Exchange, and I know I'm going to butcher this whole name because it is got a lot of words in it.
Investment Property Exchange
Services.
You got it.
IPX Investment Property Exchange Services. And they are experts in those 1031 exchanges, and we're going to give you all the details you can possibly imagine in how those work. Danita and Tracey, welcome to the show.
Well, hi, Tom. Thank you very much.
And we had Tracey on before the end of the year, talking about some of the changes in tax structure that were going to happen as...
with part of Obama, cliff.
With the
3.8% Medicare surcharge and all of that.
And the new medical plan that people don't like us to call Obamacare, but seems like our president calls it that, so I think it's okay.
That's right, or PPAC is the official name, Patient Protection Affordable Care Act.
There it is. And that has happened.
Yes,
Not to review that show, but you were warning people that
it was coming.
It was coming, and that there was going to be some significant tax changes, and we've seen some of that happen. So.
Absolutely. And those tax changes are really what's one of the things that's driving the real estate market now in terms of 1031s. They're coming back very, very robustly.
You bet. And we're going to get into that detail. I got one other guest. Danita, thank you for coming. You were here last time, but chose not to be on air, and we're glad that you're stepping up to the microphone.
Well, thank you, Tom. Happy to be here.
Yeah. And I also have with us one of our regular experts. I have Bessie Chachas from Your Castle Serivces. She is a real estate agent extraordinaire and quite an expert in investment property transactions as well. She's an investment property owner and always happy to have her expertise. Bessie, thank you.
Tom, thanks for having me on again.
Awesome. And let's get started. Do we want to jump right in with, let's define what a 1031 exchange is. I've thrown that
term out.
That term out. We don't know what it is, so let's start there.
Start from basics, from scratch.
You bet.
When anybody sells anything, and this show is obviously aimed towards real estate or real property, when somebody sells something and they have a gain, they're going to have to pay taxes on that gain. That type of tax is called capital gains tax.
So they're selling it for more than they bought it for. That's the gain.
Yep, that's true.
We're going to back this down to
And unfortunately,
basic ABCs.
You betcha. And unfortunately, you can have a gain even if you sell the property for less than what you bought it for. And we won't go through all the math or the accounting, but because of the adjusted basis being, adjusted for depreciation and improvements versus the sales price, someone could theoretically end up selling the property for less than what they originally bought it for and still have a gain. It's artificial, but it's still treated as a capital gain under Section 1250.
And you would be taxed on that?
Yes, you would.
As a capital gain?
You betcha. But 1031, it's a part of the tax code. It's a couple of pages of the tax code, allows an investor that owns investment real estate to sell that piece of real estate if they follow the rules, if they hire us a qualified intermediary, which is required by law, and then they follow the rules and buy another piece of real estate, then that gain that they would have had to pay the tax on gets rolled over into the next piece of property. And therefore, they don't have to pay the capital gains taxes on it. So that's, in a nutshell, is what capital gains and 1031s are all about.
So you're pushing that gain, that capital gain that would be taxed forward indefinitely if you need to, somewhere in the future.
You're basically kicking the can down the road because someday, somewhere down the road, you will have to end up paying those capital gains. Although there are a couple of ways to get out of 1031s tax-free. And we can talk about that in a second or two. Obviously, one of the ways to get out of 1031s tax-free is not a pleasant subject. You die. And then what happens is that the basis steps up to fair market value, and there is no capital gains. The heirs of the property, the kids, the spouse, whoever, if they sell the real estate then, there is no capital gains to be paid. So that's an effective solution for the people who inherit the property. It's not so much fun for the person that actually had to die, but it does work.
Well, that happens. I think it happens to most of us eventually.
So, Tracy, it's only on investment property. So if a homeowner owns their own home, it's not considered the same then?
No, you don't use 1031s on the sale of your own personal primary residence. In fact, you don't need to because there's a whole other part of the tax code that lets a person sell their house and not have to pay the capital gains up to a certain limit. If they're single, it's up to $250,000 that they exclude of gains, and up to $500,000 if they're married filing jointly. And that section of the tax code is Section 121. It's their personal home exclusion.
And now, what if a person lives on a multi-unit complex?
Okay, let's say it's a triplex.
Let me jump in here, guys, because we're going to get back and get you the answer to this right after we come back. You're listening to Real Estate Radio Denver here on News Talk 710 KNUS. We're telling you all about how a 1031 can be used in your investment property strategy. Come right back. We're going to have some great examples for you. We'll be right back. Welcome back to Real Estate Radio Denver. I'm your host, Tom Souther, and we are sharing today about 1031 exchanges. This is the most exciting topic I think we've had for a while. But, this is news that people don't know and I think need to be. As a matter of fact, let me introduce everybody again. I have with me Danita Vigil and Tracy Wilson with IPX Investment Property Exchange Services. And I think a 1031 goes in there somewhere.
That's okay. Yes, it does.
IPX 1031 Investment Property Exchange Services.
That'll work.
You got it.
There's just a lot of words in there. Welcome back.
Thank you very much.
And you guys are the experts in doing these 1031 exchanges, and you act as the go-between, the intermediary between in the middle of that transaction to make sure the money is properly stored and distributed and all the rules are followed so that everything is
absolutely
copacetic with the tax code.
As we explained in the previous segment, it's a way for somebody to sell their investment property, not have to pay those capital gains taxes. And to do so, they need to have this in-between, a go-between.
Service.
Right. And we're called a qualified intermediary. Sometimes it's called an accommodator, as recognized by the IRS. And we have some essential functions that are required by law. One of them is that you have to hire us to be able to do an exchange. The second thing is that we're required to produce a set of documents that have to be there at the closing table of the sale. And then again, later on, when they're ready to buy their replacement property. That's called the exchange agreement. The other thing that's required is that we have to, by law, hold on to their sales proceeds. So they can't walk out of that closing room with that big proceeds check. Instead, we have to hold on to it until they're ready to go buy the replacement property. And then that's when we wire it out to the next closing.
You bet. And we're going to talk about the details and timing and all of that process, how that works. I also have with us Bessie Chachas from Your Castle Serivces.
Hi.
And Bessie is a real estate agent with quite a bit of investment property experience, and she has incredible questions on the details on how this is all going to work. Yeah. I'm going to kind of let you guys run because you guys have great questions and conversations about how this whole process works. When we left before break, we talked about pushing that capital gain on that property forward, and you mentioned that there were two ways that you can avoid that capital gain. Ultimately, dying
is one
which
of them.
Is not the way we recommend, but it does happen, and that saves your heirs, and it's a legitimate tool in estate planning. That should be in your plan if need be. The other would be?
The other way is to turn your investment property into your personal primary residence and use that personal home exclusion. So you're effectively using the same piece of real estate under two different parts of the tax code.
Right.
The way it works is, simply put, and this is very simplistic, you exchange into one property or two of them or 10 or 100 1031 exchanges, your gain is getting bigger all along the way. Even if the real estate market sucks and it doesn't cooperate, the gain gets bigger because the depreciation recapture.
Right.
So on the last piece of property, if you do the following bullet points with this magic trick, you can get your gain out tax-free, not just tax-deferred. So the last piece of property that you end up exchanging into, first of all, it needs to be something that you can live in. It needs to be residential in nature. So to do this magic trick, it won't work if you buy raw land. It won't work if you buy a single family or a commercial warehouse or strip shopping mall.
Office building,
yeah,
blah, blah, blah.
But if it's a townhome, a condo, a house, that's fine. So you must own it for 5 years. It's got to be residential. And for the first year of those 5 years, you got to treat it as an investment. Otherwise, the exchange you did going into it
was invalid.
And it unravels, and you don't want that to happen. And they just recently changed the law so that if you treat it as an investment for the first 2 years, then they now grant you a safe harbor, which means in a way you have an audit pass of sorts from the IRS. So after the first year or 2 years of treating the property as investment, after that, what you can do is the following. Go and live in the property, and that won't mess up the exchange that you just did.
Right.
If you live there for at least 2 years, and by the way, the 2 years don't have to be all contiguous. You can live there 8 months, go down to Phoenix and watch spring training in the Rockies for 3 months, come back there and live for another 6 months, go to Florida, visit the grandkids for a while. As long as you rack up 24 months or 2 years at a minimum, then at the end of the 5th year of holding the property, if you want to decide to sell it at the end of that 5th year, you can. And what you'll be able to do is to pull out up to a maximum of $500,000 tax-free if you're married, filing jointly. If you're single, it's $250,000.
Wow.
So you've turned that gain.
You're back to the 2 out of 5 years.
Yes.
Basic rule in investment property ownership.
Absolutely. You bought the property using 1031. It's investment property. Over time, you've turned it into your personal primary residence, taking your gain out tax-free. So there are some limitations to it. There's some other qualifications. For example, the depreciation part of it, that doesn't ever come out tax-free.
Oh.
Sure.
But the actual gain, Bessie, but the actual gain itself, which you would have had to pay the tax on someday, at least that portion comes out tax-free. It's a nifty little trick. And the IRS has blessed it, and people are using this even more and more.
Yeah. And that's a new one for me. I didn't know that one was there. That's tremendous. That's a huge tip for investors out there that are rolling their gains forward. You know, a way you can, safe harbor, that's a huge chunk of change.
Absolutely.
You're talking $500,000 tax on, what's the capital gains rate on $500,000?
That's a great segue. Thank you so much. The capital gains rate now has changed dramatically. When we were on the radio a couple of months ago, we were talking about the fiscal cliff and the new 3.8%. Well, one of the things that's changed significantly starting January 1 of this year is that capital gains tax rate has changed a lot. Last year and for several years previous, it was 15%, 1.5. Right. This year, capital gains is going to be either 15%, or if you're above a certain income threshold, it could be as much as 18.8. Where in the heck does that come from? It's the 15% plus the 3.8% surcharge. So that's 18.8. Or if you're even a higher tax bracket, then your capital gains would be 20%. But don't forget to add the 3.8, so effectively it becomes 23.8%. So we've got 4 effective capital gains rates. We've got 0, which I didn't mention. It's for those people that are in the lowest 2 marginal tax brackets. But don't forget, even if you don't pay the capital gains tax rate because you're in the lowest bracket, you got to add the gain to your income anyway, which may eventually shove you up.
Yep, exactly.
So the other, as I said, there's 4, so there's a 0. There's 15%, and then there's 18.8, and then there's 23.8. And then don't forget what a lot of people do forget, the depreciation that you've taken over all the years that you own the real estate. That gets taken back, it gets recaptured, and the IRS will tax it at 25%. So now you've got either 15, 18.8, 23.8, and the 25% recapture. And don't forget, state of Colorado gets its pound of flesh at 4.6%. So when you look at all 3 of those different capital gains added up, the blended or effective rate could be about 35, maybe as bad as 40% capital gains. Bessie's falling out of her chair.
Bessie just fainted and fell on the floor.
All right, I'm back.
Because, Bessie's got a property that, she's legitimately thinking
we're going to get a
using
lot more
this
phone
tool
calls. We've gotten a noticeable increase in terms of 1031 activity. They've been, somewhat, they haven't been around that much over the past couple of years, but boy, have they really ramped up now.
Right.
And of course, the real estate market's doing a whole lot better.
It is. And I did a 1031 about 6 years ago on a rental property we had, and we ended up buying a investment condo in the mountains, which was a horrible mistake, but that's a whole other story. And it was a fantastic experience and saved us an astronomical amount of money.
Terrific. That's one of the reasons I like my job is I help them save a lot of money.
Yeah. And we're not talking a $10,000 service here. This is a very reasonable cost to make this all happen for you, especially when you consider the amount of tax savings. So this is a no-brainer service that people need to understand and know. And it's funny how these situations come up. I just had my neighbor. I was out walking the dog about 2-3 weeks ago, and she has a property up in Montana that they want to sell, and she was going on about this very subject. I'm going to get hit with a big capital gains, and we want to ultimately retire now in Grand Junction or Glenwood, I believe. And I said, no, you have to do a 1031, and here's what you do, and here's some contacts, and they're going to go down that path.
Oh, very good.
Because it makes sense. These things work.
Yep. If they're going to end up owning real estate anyway as a part of their portfolio, then why pay the capital gains?
No.
Just successfully defer it. One of the things I think that they want to think about, besides making sure that they get a qualified intermediary that knows all the rules and the ins and outs, is to choose a qualified intermediary that is safe. Because unfortunately, our industry has had some severe black eyes. And unfortunately, the state of Colorado seems to be blessed with a bunch of these knuckleheads that took clients' monies and, bought their Rolls Royces or whatever, and then they went bankrupt. And in many cases, not only do the clients then, their money is gone, but then the IRS turns around and tells them, you know what, pay the tax anyway. They can't complete their exchange. So these defalcations...
So they have defaulted on the escrow accounts.
Yes, indeed.
Ouch.
So the things that I think you want to look for when you're shopping for a QI or qualified intermediary or accommodator are a couple of things. One, you want to look for a QI that doesn't commingle the funds, because our industry is not regulated. There's no licensing requirements. There's nobody over the IRS. There's nobody at the Comptroller of the Currency. There's nobody govern us per se. So one of the things that we do, we never have commingled, so we don't commingle.
And that's incredible because as a real estate agent, you have to have a separate trust account for all security deposit or earnest money and whatnot. You cannot. I can't believe that this function is not regulated at that point.
Yep. And we not only maintain the fact that we don't commingle, we actually put it in the investment agreement so that it's there in writing. We just don't say it. We just don't talk it. We put it in writing. Then we keep separate segregated accounts on top of it. That means that the clients' monies are never commingled with our firm's operating assets.
Right.
And separated, meaning that client and that one over there are never commingled together as well either.
Yeah.
And take it a step after that. We actually put the client's name on the account with their taxpayer ID. If something goes wrong with us as a firm, all the client has to do is walk into the bank with their driver's license, and their money is theirs. It cannot be attached.
Yeah, the reason I wanted to throw in my little story and my neighbor's little story is because sometimes we talk about these large numbers. and we talk $500,000, and we talk $1 million, but mine was $30,000, in gain. And my neighbor's, I'm sure, is not huge. Hundreds and hundreds of thousands of dollars. So this is not just a tool for the super wealthy. It's a tool for the everyday investor.
Oh, absolutely.
That absolutely is a positive tool to push that tax liability forward.
For every $1,000 of gain, you're looking at a potential liability of about 30 to 40%.
Right.
I mean, $300 to $400.
Right.
I mean, ouch. So whether you're a small investor, medium-sized, or a large institutional investor with a portfolio, use 1031s. They're a great tool.
No, my 1031 I feel saved me in the neighborhood of $10,000.
Oh, wow. That's a lot.
For probably $600 at the time.
Yeah, for $500 or $600 investment. Yeah, it was
great.
huge. It was a big liability.
Now, you had a question, Bessie, about you have a duplex, and you lived in half of it, is what you were saying.
Yeah, so I live in half.
And the other half you rent out.
And I rent out. So say if I sell the building.
How does a 1031 work with you?
Right, because then I'm also a homeowner that
on the half
lives in one half, and then I invest the other half.
Well, good news. You win both ways. On the half that you live in, you get to take your personal exclusion. If you're single or if you're married, you get $250,000 or $500,000 excluded from your capital gains for that half of the sale because you live in half of it. It's your home. For the other half that you rented out to the tenants, you get to do a 1031 exchange.
Okay.
Now, I'm assuming, of course, that you've lived in your half of the duplex for at least 2 years out of the last 5.
Yes.
Cool. And as long as you've rented the other half out for the most recent year and a day, then you can do a 1031. Win-win.
Wow. Yeah. I want to go into more detail when we come back on that, and I also want to throw in second homes and vacation homes because I think there's a small exception there as well.
Absolutely.
So you're listening to Real Estate Radio Denver. Come right back. Welcome back to Real Estate Radio Denver. I am your host, Tom Souther. I have with us, well, before I do that, I want to throw out our phone number again. Please give us a call. You can reach us off air, 720-515-1818, 720-515-1818. I'd love to put you together with our guests from IPX 1031 Investment Property Exchange Services.
Way to go. You got that
was
nailed.
Like all of them all together. Now I just have
first
to
try.
without doing it at 600 miles an hour. So I have Danita Vigil and Tracey Wilson from IPX 1031 Investment Property Exchange Services, Inc.
Yes.
And I have Bessie Chachas from Your Castle Serivces.
Hello.
Hello. And we left last break. And again, that number 720-515-1818. Please call. I'd love to get you together with these guys. We're going to have a great, Tracey and Danita have a great offer coming up to use their services. So, if you're thinking about this, have a conversation with these guys. You're going to love it. And Bessie can get that investment property listed for you.
Definitely.
And she understands that next property for you that will make you money.
Definitely.
So whether that's appreciation or cash flow or what have you, nobody knows that market like she does.
Thank you.
So we were talking about an example of a duplex. Mm-hmm. And how does that fit? Is it 250? Is it double? Give us a breakdown on that one.
Well, in Bessie's case, this is how it was flowing. Duplex.
And we'll change the numbers to protect the guilty.
She lives in half of it, so half of it is her personal primary residence, and she's lived there for at least 2 years. And the other half she rents out to a tenant. So it's a win-win situation with her because when she decides to sell the property, let's say she sells it, we'll make up a number, for $600,000. The half that she lives in, she gets to take her personal exclusion because it's her home. So if she's single, she'll get up to a maximum of $250,000 tax-free. If she's married, she'll get a maximum of $500,000 capital gains out tax-free.
On her half of the duplex.
On her half.
Her half.
The other half is investment property. And therefore, when she sells the whole thing, she'll be able to do a tax-deferred 1031 exchange on just that half that she rented out. And that gain gets rolled down the road. And we just explained in the previous segment, eventually, someday, she'll be able to pull out that gain tax-free with just a little bit of a lifestyle change.
Right.
So that's the example in terms of that. The other thing that we were talking about before the break was in choosing a qualified intermediary and a combinator, some of the things you want to go shopping for. One of them was commingling, the fact that we do not commingle. You don't want anybody that does. We also need to tell you that at IPX, we make sure that to move money around, to open an account, an exchange account, to send money out for earnest money, to send it out for the purchase closing, it takes 3 signatures. The bank has to sign off on it. IPX, of course, signs, but the client's got to sign. In other words, the client's money can't disappear. It can't go anywhere. They know where it's going because they signed for it. Last but not least, we have the largest fidelity bond in the business, over $100 million. We're all CPAs and attorneys, so we have errors and omissions insurance. And then there's one thing that we do that nobody else in the business does. We have a performance guarantee bond. We essentially guarantee their exchange, no questions asked, up to a total of about $50 million. So that's us. Those are some of the things that I think you need to go shopping for, questions you should ask. The client, by the way, when they do an exchange, they are not allowed to use their own accountant or their attorney to actually do the exchange. Certainly they want to rely on them for advice and the calculations. Great. But they actually can't do the 1031 exchange. They have to hire us as a QI, qualified intermediary.
Very nice.
Cool.
And I think this is not something that you want done by the shady guy on the corner.
No, you don't want
these transactions.
You
are
essentially don't
potentially
want a
big
mom and pop firm. You want somebody that's got some very deep pockets. Of course, we do. We're actually the largest QI in the United States. We're a nationwide firm. We're the only really effective nationwide firm left. And of course, 1031s can be done anywhere in the country.
Yes.
You can sell in Colorado, buy in Nevada,
Florida,
anywhere.
buy wherever.
Absolutely.
Yeah. Which is, my example with the neighbors. They're selling in Montana, buying here, buying in Colorado. So, yeah, it works everywhere. Let's break off a little bit because you guys are doing some classes and some education. And Danita had some detail on that. I wanted to let you share that with everyone. And who's the intended audience, and tell us dates and how do they get in contact?
Okay. Well, immediately we have 3 classes coming up with Homestead Title, and they're all 9 to 11 and all in 3 different locations. The first one is April 23rd at Homestead Title, the Lakewood office over there at 710 Kipling. And that topic is just a really neat class that Tracey has developed called the Economic Forecast. And all the classes are also 1 free continuing education credit for any licensed real estate professional. And then the second one is the 24th, the very next day, at the Homestead Title office in the Tech Center. That's just right off of Orchard Road over there to
Orchard
the south.
and 25.
Right next to Del Frisco's.
They're going to buy lunch?
Maybe. We'll have to talk to Tom Geisen about that, right?
They're probably not going to take everybody to Del Frisco, so we're not going to put that out there.
Maybe donuts, coffee.
Tom would hunt me down and kill me for that one.
Hey, but the title of this one's called Barstool Economics, so we could always do shots.
First round of drinks. I might be tempted to help you out.
There you are.
And that one also includes 1031 essentials. And, agents right now, they need a refresher if they haven't done an exchange for a long time. And then, of course, there's the new agent that wants to know what is this about. So it's just a great way for them to come and get the basics. And, again, the refresher for the more seasoned agent who hasn't done one for a while. And then that third class is at Homestead at the New North office, which is 120th and I-25, just on the east side of the highway in the Citywide Banks building. And that one's going to be the economic forecast and 1031 advanced topics.
Okay, and the target audience here is agents, is real estate agents.
Agents, but commercial brokers.
Commercial brokers.
If anybody... Investors, if anybody's interested...
So this is potentially, a public event if you're an investor and want to come and figure out a little bit more about what's going on with the 1031.
Absolutely.
It's the best way for us to get out the good news of 1031 exchanges.
And I'm sorry, Danita, I walked on you there.
No, that's okay. Well, I just wanted to mention that we do business with all title companies, everybody, CPE credit for accountants and CPAs, continuing legal education credit for any attorneys. And if anybody's interested in any of these topics or classes, I could just shout out my number. I keep the calendar.
Shout away.
You're welcome to call me, and I'll get you on the calendar. My number is 303-242-6572. And I'm just happy to schedule it up, get you on there for any of your real estate offices, any of your law firms, any of your accountant firms. We'd love to help. Let us know how we can be there and help you.
Yeah, and I'm going to make this very, very simple. If you text our off-air number 1031. Just text the numbers 1031. I will send you the schedule, and I will send you the contact information for Danita and Tracey at IPX 1031 Exchange. So just simply text 1031 to the off-air number 720-515-1818. Again, 720-515-1818. And I will get you that schedule, and I'll get you the contact information for Tracey and Danita so that you can get to one of those classes if you so desire, or get whatever information you need. So
we're all over the state, actually. We go all the way down to Pueblo, as far north as Fort Collins. Tracey's going in mid-April to the Western Slope, so we're
doing 4 presentations out there.
Everywhere
Fantastic.
You need us to be.
Yeah, well, it works everywhere. So
and all the consultation, by the way, Tom, is completely free. It's a part of our service. So people can call us up and they can talk to me about what if they own the property not as an individual, but if they own it in an LLC or a partnership or a trust. How do we structure the exchange then? If they have questions about their basis and their gain, I'm not going to replace their accountant, but I can help them understand it in only 2, 3, 4 minutes on the phone, and they'll actually understand it. Sometimes when they talk to their CPA, they speak spreadsheet-ese, and I don't. I speak in regular English, and they'll understand what's going on.
Well, we're going to come back in just a minute and get you a little more information. We're going to have some more examples for you on how this 1031 can be worked into your life. We want to talk about second homes. And some properties that you might not think would qualify. So we want you to come back. I also want to throw out a little tease here because I really want you to go and like our Facebook fan page, Real Estate Radio Denver. On Facebook, and we are going to give away an iPod Shuffle. Sorry. Gosh, pods. I am Mr. Technology. I'm scaring myself. So we want you to go and like that page. Come on back. We're going to give you some more detail. Thanks. Welcome back to Real Estate Radio Denver. I'm your host, Tom Souther, and we are here in studio with Danita Vigil and Tracey Wilson from, I'm going to get this right, IPX 1031 Investment Property Exchange Services.
Right on.
And we also have Bessie Chachas from Your Castle Serivces, real estate agent and investment property owner.
Thank you.
And I wanted to throw out our iPod Shuffle giveaway. Go to our fan page on Facebook, Real Estate Radio Denver, and become a friend. Is that the right term, Susie? Yes. Like it. And we are going to draw one of those per month, or at least next month. I'm not going to say every month. At the end of April, we're almost, into April, and we're going to send you an iPod Shuffle. We'll contact you, and we're going to send you an iPod Shuffle. So if you're already, if you just go in and like, and we're going to throw in the people who are already likes, because it wouldn't be fair if we excluded them. But because there's not a whole huge number, but go and like the show, and we're gonna give somebody an iPod Shuffle. So make that happen. Watch us grow. We think it'll be fun. And you can always find on that page information about what's going on in the show. You can find the links to prior shows if you want to go back and say, oh, what did they talk about 1031 exchanges? You can get that information. So with that said, let's move on. And we had teased about second homes and vacation homes, and they aren't necessarily, most people don't consider them investment properties.
But they can be treated as such for 1031 purposes.
They can.
Yep.
Cool.
And
Let's talk about that.
Yeah, there's some brand new rules, some greater clarification, because in the past, this was one of those gray, semi-nebulous areas of the tax law on how to treat the vacation property or the second home. Was it to be treated as a personal primary residence, a second home? Was it treated as investment property? So I'll set the stage a little bit. If you've got a 2-bedroom, 2-bath, ski-in, ski-out condo, and you rent that condo out for most of the time during ski season, even during the summer, people going up there hiking, and so it's rental property. It's investment property, but maybe a week or two during Christmas, you might go skiing with the kids. Maybe, they come back in March and they're skiing again over spring break with the kids. So now if you decide to sell this vacation property, do you get to use a tax-deferred 1031 exchange on it? Or can you? Because it's investment property that has essentially been tainted by you with your personal use.
Personal use. You bet.
So how does all that work? Well, the IRS says, okay, we will let you do a 1031 exchange, a tax-deferred exchange on that property if you follow some brand new rules. And here are the rules. There are essentially 3 of them. So rule number 1, if you're going to be looking at vacation property, is that you need to have owned that property for the most recent 2 years, and it's 2 full years, so it's 24 months that the IRS is going to be looking at. The second rule is that of those 2 years, for each 12-month period, the IRS says, hey, you need to limit your personal use of the property to no more than 14 days for each of those 12-month periods. And then the third rule says, hey, you must offer it for rent. You need to make it available for rent more than 14 days of each year for the 2 12-month periods that you've owned it. So in light of all that, if you stay within those guidelines, it gives the client a safe harbor so that they're able to sell it, able to do a 1031 exchange. There's some wiggle room that's built into those new rules. For example, you're supposed to restrict your own use of the property to no more than 14 days. Well, the wiggle room that's built in there, if you look at the language, says limit yourself to 14 days or 10% of the amount of time that you made it available for rent. Wow. Okay. So if you offer it for rent 300 days out of the year, then 10% is that's 30 days. So that means you could have personal use for 30-some days.
Now, there's a key word in there, I think, offered for rent.
Yes, because there's some properties that just don't rent, as long as you made a bona fide effort to actually try and rent the property out.
So my property that I had listed in one of those vacation rental websites, we won't mention any names, and it's on that site all year, every day, all year. So I've made it available for rent 365 days.
Yep. And so
even though I may only rent it 75 or 80 days a year.
Again, the client always needs to check with their accountant on how they want to file their tax return, but you need to be it needs to be a bona fide effort to offer that for rent. Keep good records. If you've listed it on that website, make sure you keep a record of it. If you use the property, you go up there for 2 or 3 days, keep a record of it. If you have maintenance days, keep a record of that. Keep your invoices if you buy a couple of gallons of paint from Home Depot or whatever. So just keep good records, and you'll be just fine. If you want further, advice or anything, I can walk the client or their attorney through or their accountant through the scenario and get it to work for them.
Yeah, and we always encourage you, use your professionals.
Absolutely.
If you have an accountant, run this by them.
Absolutely.
Make sure you're getting good advice. If you need someone to run it by, we can help you with that too.
Yeah.
I don't want to have anybody running around saying, well, I heard and this is the end all, because every situation is a little different. So, but we like to talk about these broad rules and give you some ideas. Now, when I did my 1031 exchange, this was some time ago, 5 or 6 years ago, I thought there was some IRS ruling about not even that rental use portion, that if you were buying that home with the intention of holding it for appreciation, investment appreciation, that even some of that usage rules were less
to be able to use for your
debatable.
advantage.
Or is that so obscure that we're picking nits?
No, it's still in there. I mean, for example, all these new rules that I outlined, the 3, just give the client a safe harbor. If they obey those rules strictly and adhere to them, then there should be no problems with them being able to do the exchange of that vacation property. It's when you begin to go outside of those safe harbor guidelines and you want to look at other things, other parts, other fact patterns of the situation. For example, you are allowed maintenance days on the property. So you could go up there and they don't count against your personal use. So maintenance days. You can do other things like moving some of your expenses from Schedule A over to Schedule E. The more fingers, auditing-wise, accounting-wise, that you can get pointing to that piece of property being treated as an investment and not solely for personal use, the better off your exchange is going to be.
Sure. Makes sense.
One of the other things I thought we were going to maybe sort of touch on is personal property exchanges.
Yep,
absolutely.
Let's talk about
that. So we've sort of focused on naturally the real estate aspect of it. And when we're talking about doing real estate in 1031s, I want to make a clarification. If you sell a rental condo, for example, you don't necessarily have to go buy or exchange into another rental condo. The words like kind
that's a great point.
Yeah, it's a somewhat of a misnomer of sorts.
Right.
You can exchange into raw land. You could exchange into commercial office space.
You could sell a condo and buy a fourplex or a commercial building.
Yes.
Anything.
As long as it's real property somewhere in the United States, you're going to be good to go. And when I broaden that word from real estate to real property, that means we include other things that are equal to real estate.
Ferrari.
No. Real property.
Why not?
As in oil and gas and water rights and air rights and mineral rights and conservation easements and all those things are fee simple interests in real property. So you could sell the rental condo and go invest in oil and gas properties, for example.
No Ferrari.
But now the Ferrari, that would be personal property. So there's like two different universes of 1031s. One universe is for real property, real estate, and the things that are equal to real estate. And the other universe is personal property that's used for business. So if your Ferrari is used for business, it might qualify.
Of course it is.
If you have a fleet of vehicles, construction equipment, cattle, horses, businesses themselves. IPX is one of the largest personal property exchangers when it comes to intellectual property, copyrights and patents and trademarks. We've done some very esoteric exchanges.
So give us some examples of some of the fun ones.
Oh,
Danita,
well,
you were throwing some of these out. And,
sure.
why
The Andy Warhol soup can paintings.
Mm-hmm.
Those have been involved in exchanges.
Nice.
Saber-toothed tiger skulls.
Found in the desert.
Can you imagine? Yeah. And
I can't imagine.
any collectibles, anything, that's valuable in that realm. There's
They
just
can all
all
be done
kinds
as
of
a
things.
tax-deferred exchange.
You bet.
Yeah.
That's amazing.
Collectibles, art.
So my matchbook collection would probably not. Sorry.
I don't know if you'd have a
There
game
really
on that
isn't
one.
a matchbook
Marbles.
collection. I'm just
Baseball card, though, collection. Yeah, certain maybe marbles. I don't know. I'm losing my marbles here. So personal property exchanges can be done, but then there's one thing you want to keep in mind, two, actually, and that is, one, if you sell real estate, you sell the rental condo, you cannot go exchange into something that's personal property. So in other words, you can't go buy an RV or a boat. So you can't cross from one universe to the other.
Even though from a tax standpoint, an RV or a boat might be considered a second home.
Yes, right, exactly.
But still, it's not
can't do
not
it.
gonna work. Okay.
One's real property, one's personal.
Right.
The other thing you want to remember, like kind, when we were talking about real estate, real property was wide open. You can buy and sell anything, except for your personal primary residence. But on the personal property side, when you sell a car,
A saber-toothed tiger skull, you have to go acquire
you got to go get another
a
collectible.
T-Rex skull or something.
Well, if you sell a car, you got to get a car. They won't let you deviate and get a truck. If you sell an airplane, you got to get an airplane. They won't let you go and get a boat. So like kind, definition-wise, on personal property is much more rigid. It's more narrow.
Hey, Tracy, tell
Interesting.
the cool story about the horses. I love when you tell that story.
All right. Well, to make it quick, a guy had an Appaloosa horse. He put it out to stud. His gain on the horse was, north of $200,000. So he's happy. The horse is happy. Little humor.
Horse is happy.
There you go.
Yeah, horse is very happy.
And he didn't want to pay the taxes, of course, on that $200,000. So what he wanted to do was do an exchange. He
And
wants
God
to buy
knows
some.
the horse wasn't going to pay.
That's
No.
right. And so he's going to buy some horses for his granddaughter. And she was a barrel racer in the United States, actually the #1 barrel racer. And the type of horse you use for barrel racing is a quarter horse, not like kind to an Appaloosa. We couldn't get the exchange done.
Horse? No.
Horse
Wow.
is not a
Horse for
horse.
horse.
Horse of a different color. That was several years ago. Now the laws have changed. So you want to pick a QI that knows and keeps up on even the most esoteric of items. Now today we could get that exchange done because there's what they call a general asset category that we can go from an Appaloosa to a quarter horse. But that's how rigid and narrow sometimes
Yeah,
the like
that's-
kind definition.
Yeah.
But then after that, though, Tracy, can you go back and to say that you first did a 1031 exchange on an investment property and then bought a horse, and then can you put it back into an investment property
Well, again,
on your third exchange?
you can't go from real estate to a horse
To a person,
and
right.
back because that's going from real estate to personal property.
Okay.
Yeah, so you can't cross that boundary. But like we discussed the tax-free exit strategy on real property, unfortunately, there's no tax-free exit strategy for personal property like horses. Someday you're going to have to end up paying the tax type of thing. The other thing I wanted to mention, because I think this is very unique, many clients, investors are perhaps reluctant to enter into a 1031 exchange, or if you are going to start an exchange, one of the things you might be worried about is that you've only got 45 days to identify the property you might want to buy. You only get 180 days to close on the purchase of that property. If you are worried about the exchange and if it fails, we now have a tax-deferred solution, even if the exchange fails, and we're the only ones in the country that have got it. And it works simply like this. At the end of your 180 days for the exchange, normally if the exchange fails, on day 181, we give the client all their exchange proceeds back. Well, instead of giving the exchange proceeds back, with them, we consult with them, we actually steer the monies to Allstate. So Allstate and IPX have partnered together. Allstate now has the money. The client didn't get it, so they don't have to pay the taxes.
Right.
But the bummer is Allstate's got their money. So we created that exact same time an annuity so that Allstate does pay the client back, and the client gets to design that annuity however they'd like. So that lasts for 1 year, 3 years, 13 years, whatever the case might be.
So there's an incredible, you call it a 1031 rescue.
Rescue.
That's going to have to be another topic. I want to thank Danita and Tracey coming in from IPX 1031 Exchange and Bessie Chachas from Your Castle Services. Don't forget, text 1031 to 720-515-1818. I'll get you their info. Thanks.
Thank you, Tom.
Bye-bye.